Welcome to another episode of Quest for Twice. Today is November 27th. So ATKR reported its fiscal Q4 results. The results were pretty solid. Compared to 1 year ago, its price decline caused a revenue reduction of 17%. That's actually a deceleration from a 19% reduction in the fiscal third quarter. And its volume was up 2%. So let's look at the segment results. The electrical segment revenue was $650 million compared to almost $800 million 1 year ago. That's caused by the price decline I just mentioned. And its mechanical segment revenue was 220 million compared to 234 million 1 year ago. So it's about 5% decline. On the margin side, that's pretty encouraging that the electrical segment EBITDA margin was 37% compared to 39% 1 year ago. So despite the large price drop, its margin only suffered 2 percentage points. That's because of the price decline was offset by the cost decline. And similar story on the mechanical side, the margin declined 2 percentage points because the cost decline partially offset the price decline. Nevertheless, the total quarterly EBITDA was $232 million compared to $325 million 1 year ago. So if we look at the quarterly EBITDA, it was a peak at 325 million, then declined to about 270 million in the first, second, third fiscal quarter of this year, before another step down at 232 million. Then the full year EBITDA came in at slightly over $1 billion, comparing to the initial guidance between $850 to $950 million given at about 1 year ago. That's because of the less severe margin decline as initially guided. The management gave a guidance for the first quarter 2024 EBITDA around $205 million. But importantly, if we look at the full year EBITDA guidance, as shown in the chart on the top right, we can see that the full year EBITDA peaked in fiscal 2022 at $1.34 billion, then declined to $1.04 billion in fiscal 2023, which was higher than fiscal 2021, which by itself was an excellent year. The management guided for the fiscal 2024 EBITDA will be between $900 and $950 million. The management has a track record of under-promise and over-deliver. So I believe the full year EBITDA will likely exceed the guidance. So we are talking about on average a quarterly EBITDA about $250 million. So for the fiscal year 2023, CFFO was a little over $800 million with the working capital holding steady. Capex was about $220 million, acquisition $83 million, and the buyback $490 million. So ATKR was generating a lot of cash and used most of that to buy back shares. Now it has cash on hand for about $388 million versus total debt of $773 million. So the net is very little. The management also mentioned the company will start paying dividend in first quarter 2024 in the amount of 30 cents to 35 cents per quarter. So based on the guidance, the management believe the first quarter 2024 likely will be a trough in terms of EBITDA. Then it will rebound back. So for the full year 2024, EBITDA will only be about $100 million less than fiscal 2023 at the higher end of the guidance. That's very interesting because if we look at the management discussion 1 year ago, as shown in the figure in the middle of the three graphs on the right, comparing to 2017, the EBITDA increased to $985 million in 2022. $400 million of that is considered the sustainable pricing improvements, and $585 million was considered of pricing outperformance. The management mentioned $250 million out of this 585 already occurred in fiscal 2023, and a similar giveback is expected in fiscal 24. And based on the results in the fourth quarter 2023, 175 is already happening. So with such a severe price normalization and impact on EBITDA, why does the fiscal 24 EBITDA guidance is only $100 million less than fiscal 23? The answer can be explained by the figure on the top right. The management gave an estimated product growth in the key areas in 2024. So for the plastic pipe and the conduit and fittings subsegment, next year the volume and the mix is expected to grow mid-single digit to high single digit. For the metal framing, cable management and the construction services subsegment is expected to grow in the high single digit compared to fiscal 23. The metal electrical conduit and fittings subsegment is expected to grow in the low single to mid-single digit next year, and the electrical cable and the flexible conduit is expected to grow in the low single digit next year. And finally, the mechanical tubing subsegment is expected to grow in double digit compared to this year. That's because the management is expecting very strong volume performance with solar-related products on pace to nearly double the amount of sales next year from this year. So the management is expecting very strong volume growth next year. That's the key reason of the larger offset to the EBITDA reduction from this year due to price normalization. The good news is the end of the price normalization is in sight. Most likely will happen in the fiscal first quarter 24. However, the volume growth will keep going based on the long-term secular trends. That means we should have confidence in the EBITDA growth in 2024 and 2025 and beyond. The management also provided additional insight related to its segments. Based on revenue, electrical segment was 76% of 2023 net sales, and 16% out of the 24%, i.e. 2/3 of the mechanical segment, is related to safety infrastructure. That's considered the electrical support because the key products include cable tray, construction services, metal framing, prefab devices, solar support, and substation protection and securities. So that answered a key question I have always been thinking about. That is, what's the synergy between its two main segments, the electrical versus mechanical? This graph shows that because a two-thirds of its mechanical segment is considered electrical support, then that likely will mean these products will go through the same distributors as its electrical products. So there is indeed a synergy there. Now let's look at its valuation. At $130 per share, its market cap is 4.9 billion and the enterprise value of 5.3 billion. So EV over EBITDA is about 5.3 if we use a $1 billion sustainable EBITDA, which may not be reached next year, but I'm confident will be reached in 2025. That's because of the torque tube, HDPE, and the regional service center investment will drive growth in next year and beyond. And there are multiple secular trends, including charging network, broadband, solar power, data center, and warehouses will be going on for multiple years. As a comparison, Hubble has a EV over EBITDA about 16.8. That's much more expensive than ATKR. Another way to look at the valuation is using the PE ratio, which is about 7.2 if we use $18 guided by the management for fiscal 25. The third and final way to look at valuation is to look at the free cash flow. Last year, it was about $500 million. That's after paying tax and interest about $300 million and spending about $200 million on capex. The large amount of free cash flow is almost 10% of its market cap, and that has been used for acquisition to grow future business as well as to buy back shares. So that's reflected by the outstanding common shares at the end of fiscal 23. That's about 39 million shares. That's a more than 10% reduction from 1 year ago, which was about 10% reduction from 2 years ago in September 2020. So we can see ATKR has been consistently generating cash and using that to buying back shares, which I considered as an excellent use of capital because how inexpensive its share price is. So I believe the original invest case is still valid. NVDA also reported its quarterly earnings last week, so let's take a look. 3.5 months ago, I said NVIDIA had a nose-bleeding valuation level based on its enterprise value over its gross profit. So something amazing happened. So based on the last two earning updates as well as outlook for the entire 2023, we can see that the estimated 2023 revenue will be close to $60 billion compared to less than 30 billion in 2021 and 2022. So that level of revenue growth is just unprecedented for such a big company. Also, we can look at the gross margin. There was a bump up in 2021. That's because of the frenzy in building data center during the pandemic. Then it dipped in 2022 during the tech downturn. But now for the full year, the gross margin is expected to be over 70%. That's a significant jump up, indicating a great amount of demand for limited supply of NVIDIA's chips. So this is an example of business growing so fast to justify its nose-bleeding valuation appear to be in the summer. However, even if we use the full year's guided revenue and gross margin to calculate the gross profit, we can see at the current stock price, the EV over gross margin is still close to 30. That's still higher than any point before the pandemic, including the last artificial intelligence boom triggered by Google in 2016. So I would say the current valuation level is reflecting very optimistic view of the future. Now let's take a look at the quarterly revenue information and the gross margin. In this chart, I plotted the overall NVDA quarterly revenue since April 2017 to the guided revenue ending in the quarter of January 2024. I also provided the data center segment revenue, which I think is very insightful. So we can see the quarterly revenue steady increase during the pandemic from January 2020 to a peak in April 2022. Then afterwards, there was a dip for about 3 quarters. However, we can see that the data center revenue actually held pretty steady, although the overall quarterly revenue had a decline. Then the current AI boom hit. You can see that in the quarter ending in June, the revenue in the data center segment just more than doubled sequentially. Then had another significant increase in the most recent quarter. However, I should also point out that the magnitude of increase sequentially from the summer quarter to the third quarter is not as big as the first jump from April to July. So there is some deceleration. And if we look at the overall revenue trend, we can also see that the management guided decelerated revenue growth overall in the quarter ending in January of next year. Now let's take a look at the gross margin. We can see the gross margin ticked up during the pandemic from 2020 to early 2022, then had a big dip before it rebounded to about 65% about 1 year ago. Then with the current AI frenzy going on, the gross margin had a quick ascent to about 75%. The management guided the current quarter will have a similar gross margin, so that is stabilizing. So I would say the initial sugar high is fading. What's going to happen next is really about how AI will help the productivity increase and how quickly that will happen. We know that the major cloud service providers, including Amazon, Microsoft, and Google, has been purchasing a lot of NVIDIA's chips. Then they are offering their computational capacity to the software companies. Then the software companies have been busy building AI model based on large language model. Then the key question we have now is, are those new software dramatically increase productivity, rewarding those software companies that invested so much money to build new applications? If that is the case, then the demand for additional AI computational power will keep growing, and that will drive the additional demand for NVIDIA's chips. Otherwise, the revenue will stabilize, maybe growing at a much slower pace. In that case, NVIDIA's valuation level is unsustainable at the current EV over gross profit level. That's why I believe the current price of NVIDIA stock is optimistic. It may turn out to be okay because again, its business may grow into the optimistic valuation level. But there is a still significant downside. I will be watching the software company's revenue for important clue on the future demand for the AI computational power and NVIDIA's data center chips. Stay tuned. Until next time, happy investing.